For years, California's rental scene felt unstoppable. Prices kept climbing, demand constantly outran supply, and renters scrambled for apartments as if they were rare prizes. But by 2025, the story has flipped, and now it's the landlords feeling the pressure. All across the Golden State, rental listings are stacking up. Vacancy rates are hitting heights unseen in nearly 10 years. A mix of new housing construction, fewer people moving in, and soaring living expenses has sparked a market correction few could have predicted. Data from Zillow and Redfin shows that rental prices statewide have fallen by an average of about 6% this year, with certain cities experiencing drops in the double digits. Luxury units that once fetched sky-high prices are now sitting unoccupied for months. As a result, landlords are offering tempting incentives, from free rent periods to steep discounts in cities that not long ago were notorious for being unaffordable. Welcome to Discover the Cities. Today we're diving into the 10 California cities where the rental market is unraveling fastest and uncovering the real reasons behind this dramatic shift. Before we jump in, don't forget to subscribe and turn on your notifications. Every day we bring you data-driven stories about how America's housing landscape is changing, where the numbers meet the people living them. Let's get started. Number 10, Santa Clarita. Just a short drive north of Los Angeles sits Santa Clarita, long celebrated as Southern California's picture of suburban perfection. With spotless streets, top-rated schools, and an enduring sense of safety and stability, it offered everything LA didn't. For years, it was the dream escape from gridlock and city chaos. But by 2025, that dream is starting to fade. Santa Clarita's rental market, once sizzling hot, is now cooling faster than anyone could have imagined. Vacancy rates have jumped to 7.8%, the highest in nearly 10 years. The average rent for a two-bedroom apartment, which used to hover around $2,900, has tumbled to roughly $2,250, and prices are still sliding as landlords cut deals just to fill units. During the pandemic, developers went all in, betting big on a permanent wave of Angelenos heading north. Entire luxury complexes sprang up in Valencia and Canyon Country, promising resort-style living for remote workers. But now that many companies are calling employees back to the office, those tenants have vanished, leaving shiny new buildings half empty. They're now leasing banners fading under the relentless California sun. Meanwhile, costs keep rising. Utilities are up nearly 20% year over year, and insurance premiums have surged. The once tolerable commute from Santa Clarita to LA has become a major strain on both time and wallets. Even long-term residents are moving out, seeking cheaper options inland or out of state entirely. For the first time in years, renters have the upper hand. Landlords are offering unheard-of incentives: free rent, zero deposits, flexible lease terms, all to lure tenants back. It's a stunning turnaround for a city once known for fierce competition and scarce housing. Santa Clarita still has its charm, the clean streets, the family-friendly feel, but the math behind its housing market just doesn't add up anymore. And if you want a glimpse of where California's rental boom is starting to fracture, this is it. Subscribe to Discover the Cities, where we dig deeper than the headlines to uncover the real stories shaping America's housing future. Number 9, Sacramento. Welcome to California's capital, Sacramento, a city that once embodied hope for renters escaping the Bay Area's impossible housing prices. Between 2020 and 2022, waves of remote workers poured in, transforming the region almost overnight. Rents soared by 40% in just 3 years, construction cranes dominated the skyline, and sleek new towers promised a golden age of growth. Investors hailed Sacramento as the next big urban success story. But by 2025, the excitement has cooled dramatically. Vacancy rates have climbed to 9.2%, and average rents have slipped about 7% year over year. What was once a booming migration magnet has turned into one of California's most oversupplied rental markets. Developers, convinced the influx would last forever, kept building luxury complexes near the Capitol, along R Street, and throughout Midtown. Billions of dollars poured into projects that today are struggling to find tenants. The demand that fueled the surge vanished almost as quickly as it appeared. Many Bay Area transplants who drove the frenzy have moved on, some back to San Francisco offices, others to more affordable cities like Boise or Austin. Downtown high-rises that once had waiting lists are now dangling offers like 2 months of free rent and generous move-in bonuses. In Midtown, those stylish lofts that used to rent within hours sit dark for months at a time. Renters know the market has flipped, and they're finally the ones in control. Even local households aren't immune to the pressure. Utilities have climbed, property taxes are rising, and inflation continues to squeeze everyday budgets. With fewer state employees commuting and many offices still half empty, Sacramento's once bustling rhythm now feels muted and slow. The city's rental market isn't in free fall, it's resetting. Yet for investors who bought at the height of the 2022 frenzy, it feels like the ground has disappeared beneath them. Sacramento, once celebrated as the perfect balance between affordability and opportunity, now serves as a cautionary reminder. Even the strongest markets stumble when optimism outgrows reality. Number 8. Long Beach. For decades, Long Beach stood as Los Angeles County's quiet success story, a coastal gem offering oceanfront living without Malibu's sky-high price tags. It was the sweet spot between affordability and coastal charm. But in 2025, that story has taken a sharp turn. Vacancy rates have surged to nearly 10%, the highest since the aftermath of the Great Recession. Rents that once felt untouchable are slipping fast. The typical two-bedroom apartment that rented for $2,750 in 2023 now goes for around $2,400. Even upscale high-rises downtown are slashing prices by hundreds just to compete. 2 months free and no deposit banners now hang where waiting lists once stretched for blocks. Much of the current trouble traces back to the building boom that began during the pandemic. Construction cranes filled the skyline as developers bet heavily that demand for coastal living would never fade. But as companies began pulling workers back into the office, that calculation fell apart. The hybrid workers who once filled Long Beach's new luxury towers are now leaving, some heading back toward LA's job centers, others moving out of California entirely. At the same time, costs are soaring. Property insurance premiums have jumped more than 20%. Utilities keep inching higher, and local rent control laws have pushed smaller landlords to sell off properties or remove units from the market altogether. The result? A strange imbalance, too many vacant luxury apartments, and not enough reasonably priced homes. The shift is visible on the streets. Downtown nightlife feels thinner. Ocean Boulevard storefronts turn over more often. From Belmont Shore to Bixby Knolls, for rent signs linger far longer than they used to. For years, Long Beach represented the attainable coast, a middle-class alternative in Southern California's tightening housing puzzle. But affordability has evaporated, and demand is slipping away. Once the steady bridge between Los Angeles and Orange County, Long Beach now stands as another emblem of California's great rental reckoning. Number 7. Oakland. For generations, Oakland stood as the Bay Area's working-class anchor. Diverse, determined, and brimming with opportunity. It was the city that balanced grit with growth, long seen as the attainable counterpart to San Francisco's extravagance. But in 2025, Oakland finds itself at the forefront of the region's rental downturn. Vacancy rates have climbed above 10.5%, and average rents have fallen roughly 11%. The change is dramatic. Towering luxury high-rises that once catered to San Francisco commuters now sit half-empty, their glowing lobbies reflecting quiet, vacant hallways. Oakland's unraveling began back in 2023, when widespread tech layoffs swept through the Bay Area. Thousands of displaced workers, many of whom had relocated to the East Bay to escape San Francisco's sky-high costs, packed up and left California entirely. Hybrid work only accelerated the exodus, hollowing out downtown offices, while growing concerns over safety and crime pushed even more residents to move away. Downtown, the once vibrant hum of new restaurants, art spaces, and nightlife has dimmed. The city that once pulsed with creative energy now feels subdued, a softer echo of its pre-pandemic self. Landlords are fighting to fill units, offering hundreds of dollars off monthly rent, free parking, gym memberships, even entire months rent-free. Yet demand just isn't keeping pace. Long-term tenants are renegotiating leases with confidence, a power shift almost unthinkable a few years ago. At the same time, many small property owners are feeling the squeeze. Maintenance costs are climbing, property taxes are rising, and profits are shrinking fast. Investors who once banked on endless appreciation are now selling properties at a loss, forced to face a reality few anticipated. But what makes Oakland's downturn especially poignant isn't just financial, it's emotional. The city's deep-rooted reputation for resilience has collided with a new wave of uncertainty. Locals describe it not as an economic crash, but as a crisis of confidence. The cultural heartbeat of the East Bay still beats, but it's slower now, cautious, reflective. Oakland's housing correction will likely stabilize in time, but for now it stands as one of the clearest reminders that even California's most dynamic cities aren't immune to the consequences of overgrowth and optimism. The boomtown spirit that once defined the Bay has met its reckoning. Number 6. Los Angeles. For years, Los Angeles felt untouchable, a city too vast, too magnetic to ever truly slow down. With its unique blend of entertainment, tech, and creative energy, demand for housing seemed endless. But in 2025, even the City of Angels isn't immune to gravity. Rental prices across LA County have dropped roughly 8% year over year, the sharpest decline since the 2009 financial crisis. Vacancy rates have edged past 7%, with some pockets reporting numbers nearly double that. And it's not just happening downtown. Even the once invincible West Side, where studio apartments used to command $3,500 a month, now sees listings sitting idle at $2,800, often with incentives attached just to lure tenants. The driving force behind this shift: out-migration. Since 2020, more than 200,000 residents have left Los Angeles County, drawn to the affordability of Nevada, Arizona, and Texas. The pandemic's remote work revolution gave people the freedom to live anywhere, and many never returned. Meanwhile, developers kept building, confident that LA's allure would fill every glass tower. Instead, neighborhoods like Koreatown, Hollywood, and Culver City are dotted with half-empty buildings. The oversupply has flipped the script. For the first time in over a decade, renters hold the upper hand. Leasing offices that once had lines out the door are now quiet. Apartment managers are throwing in free rent, waived deposits, even parking discounts just to stay competitive. And the slowdown isn't limited to luxury towers. Mid-tier neighborhoods, from North Hollywood to Echo Park and Long Beach, are feeling the same chill. The city's working class, already squeezed by rising costs and inflation, can no longer shoulder the burden. For many lifelong Angelenos, it feels almost surreal. A city that once priced out nearly everyone now struggling to fill its apartments. Los Angeles isn't collapsing, it's recalibrating. But for landlords who've spent years at the top of this market, it's a hard adjustment. The glamour remains, the palm trees, the sunsets, the endless ambition, yet beneath the sparkle, the data tells a humbler truth. In 2025, the rent capital of the West Coast is finally coming back down to earth. Number 5. San Diego. Few places capture the essence of California's coastal dream quite like San Diego. Golden beaches, year-round sunshine, and a reputation for endless demand. For decades, the city seemed immune to downturns. But in 2025, even this seaside paradise is waking up to a new reality. Even paradise can overheat. Across San Diego County, rents have fallen roughly 7% over the past year, while vacancy rates have climbed past 8%, their highest point since 2010. What's most surprising isn't the decline itself, it's where it's happening. Neighborhoods once considered unstoppable, like Pacific Beach, Little Italy, and Hillcrest, are cooling faster than anyone expected. Over the past 5 years, developers have flooded the skyline with high-end apartments, banking on a steady stream of well-paid renters from the biotech and defense industries. But now, high interest rates, stubborn inflation, and shrinking household budgets have slowed demand to a crawl. Those shimmering coastal towers that used to fill within days are offering move-in bonuses, rent credits, and anything else to keep units occupied. The problem goes beyond overbuilding. It's an affordability crisis. With some of the highest electricity bills and insurance costs in California, even professionals with solid incomes are scaling down or moving out. Inland cities like Riverside, Temecula, and Murrieta are seeing a steady stream of former San Diegans chasing lower rents and shorter commutes. The shift is visible everywhere. Downtown once pulsed with energy as new residents arrived each month. Now leasing offices are quiet, and landlords are negotiating deals they never would have considered 2 years ago. We used to have waiting lists, one property manager admits. Now we just have waiting. Even longtime homeowners are feeling uneasy. As rents slide, property appreciation has slowed, reshaping expectations for the city's once booming real estate economy. San Diego's rental correction isn't a collapse, it's a return to reality. After more than a decade of non-stop price climbs, the market is finally recalibrating. Demand will come back, eventually. But for now, landlords are learning a lesson renters have always known. Even in paradise, the math catches up. If you want the real story behind the postcard skyline, subscribe because Discover the Cities doesn't just show the headlines, it reveals what happens when the housing market meets its moment of truth. Number 4. San Francisco. No city captures the extremes of California's housing journey quite like San Francisco. A place that once defined innovation, ambition, and sky-high rents. For years, it stood as the symbol of prosperity and progress. But in 2025, that same city now stands at the heart of California's most dramatic rental downturn. Vacancy rates have surged beyond 11%, a figure that would have been unthinkable just 10 years ago. The median rent for a one-bedroom apartment has dropped from $3,750 to around $3,000, and some luxury units are leasing for less than they did back in 2015. Downtown, once the humming core of the tech universe, feels eerily hollow. Streets that once overflowed with commuters now echo with the sound of footsteps and wind. The city's rhythm, once electric, has quieted to a slow, uncertain beat. The reasons run deep. The rise of remote work gutted the city's daily workforce. tech layoffs stripped away tens of thousands of high-income renters. Meanwhile, in a twist of irony, developers hoping to solve the housing shortage began converting empty office towers into apartments, flooding an already weakened market with new supply. Instead of relief, it created a surplus. Districts from Soma to Civic Center tell the same story: gleaming glass towers with panoramic views, half-lit at night. Even icons of luxury like Nema and 181 Fremont, once synonymous with exclusivity, are now offering move-in incentives and rent discounts that would have been unthinkable 5 years ago. But San Francisco's decline isn't just economic, it's emotional. The city was built on momentum, on the belief that innovation would always outpace uncertainty. In 2025, that confidence feels fragile. Many residents describe the mood as a pause, the sense of a beautiful, brilliant city, unsure of what comes next. Yet beneath that stillness, there's a quiet shift, opportunity. For the first time in years, middle-income renters can afford to live in neighborhoods that were once far beyond reach. Studios in Hayes Valley, once symbols of exclusivity, are leasing again at pre-2016 prices. San Francisco's story isn't one of collapse, it's one of transformation. The boomtown has hit bottom, but the foundation remains. The city that once reinvented global culture may soon reinvent itself again. Whether this next chapter is revival or reinvention depends on how San Francisco chooses to rise from its pause. Number 3. Riverside. For years, Riverside stood as a beacon of hope, a refuge for Californians priced out of the coast. It was the promise of space, sunshine, and a slower pace of life, a place where families could trade cramped apartments for backyards and breathing room. But in 2025, even the Inland Empire's most resilient city is showing signs of strain. Vacancy rates have surged to 9.4%, and average rents are down nearly 10% year over year, a stunning reversal for a region once hailed as California's affordability firewall. Apartment communities that were filled to the brim just 2 years ago now display glowing now leasing signs over half-empty parking lots. Some developers are even turning to billboards and social media campaigns, offering discounts that would have been unimaginable a decade ago. The reasons are rooted in overbuilding and false assumptions. During the pandemic's migration boom, developers raced to meet what seemed like endless demand from Los Angeles transplants. New complexes sprouted across Moreno Valley, East Vale, and downtown Riverside, all built on the belief that remote work would make the Inland Empire a permanent magnet for coastal escapees. But as population growth stalled and companies rolled back remote policies, that bet began to unravel. The very tenants who once fled here for cheaper rent are now leaving California altogether. Even longtime locals are feeling the pinch. Property insurance premiums and utility costs have soared, while the region's backbone industries, logistics and warehousing, have softened. When Amazon scaled back its expansion, thousands of jobs disappeared, setting off ripple effects that hit renters hardest. The irony is hard to miss. Riverside was once the solution to California's housing crisis. Now it faces its own affordability paradox: homes that look affordable on paper yet remain out of reach due to stagnant wages and rising living costs. Landlords are experimenting with every trick in the book: waived application fees, free parking, flexible leases, even months of free rent, trying to slow the growing wave of vacancies. Still, many complexes remain eerily quiet, their shimmering pools reflecting the stillness of an uncertain market. The Inland Empire's reputation for resilience has given way to a new reality, one that reveals just how fragile affordable can be. In Riverside, the foundation of optimism is cracking under the weight of overconfidence. Even in markets built on hope, when growth runs faster than reality, the consequences eventually catch up. Number 2. San Jose. For decades, San Jose seemed untouchable, the shining jewel of Silicon Valley, the nerve center of global innovation, and home to some of the priciest rents west of Manhattan. But in 2025, even the tech capital of the world is struggling to keep its apartments full. Median rent in San Jose has plunged 12% year over year, while vacancy rates have climbed past 10%, levels the region hasn't seen in more than 20 years. For a city that once thrived on bottomless demand, the reversal feels historic. The explanation mirrors the blueprint of the new economy. Tech layoffs at giants like Google, Meta, and PayPal have wiped out thousands of high-income tenants. Remote work has become entrenched, freeing employees from the Bay Area's crushing costs. And a younger generation of tech professionals, once the lifeblood of San Jose's rental market, is flocking to cheaper innovation hubs like Austin, Denver, and Salt Lake City. The fallout is visible everywhere. Downtown's gleaming high-rises, built during the 2017 to 2021 construction boom, now stand half-empty. Rooftop lounges sit silent. Co-working spaces echo with the absence of chatter. In Cerrito and Santa Clara, luxury complexes are quietly cutting rents by $400 to $700 a month just to stay competitive. Even once prestigious suburbs like Mountain View and Sunnyvale are dotted with for rent signs, a surreal sight in places that once had waiting lists stretching years. Beneath the surface shock lies a deeper shift. San Jose's housing market was built on relentless optimism, on the belief that the tech engine would never slow. But now that confidence has cracked. Investors are retreating, developers are freezing new projects, and local governments are bracing for shrinking tax revenues. For tenants, though, this downturn feels like long overdue relief. Engineers and families who once shelled out $4,000 for modest apartments are finally seeing rents fall within reach. The balance of power has flipped. Landlords are negotiating again, and renters have the leverage they lost years ago. San Jose's rental slump is more than just another market correction. It's symbolic. It marks the end of an era when technology didn't just drive California's economy, it defined its identity. The region that built the future is now experiencing what it means to come back to earth. Number 1. Bakersfield. At the top of our list, and perhaps the most unexpected of all, sits Bakersfield, California's longtime working-class stronghold and symbol of affordability. For decades, it was the final refuge for families priced out of the coast, a place where stability and opportunity seemed certain. But in 2025, even Bakersfield is facing an oversupply crisis that's rewriting its story. Vacancy rates have exploded past 12%, the highest in the entire state, while rents have plunged by nearly 13% year over year. For a city that built its reputation on affordability and endurance, the downturn is staggering. The roots trace back to the pandemic boom, when developers rushed to construct thousands of new apartments, convinced that migration from Los Angeles and Fresno would continue indefinitely. But as the economy cooled and population growth stalled, that demand evaporated. Entire new complexes now sit half-empty on the outskirts of town, their sun-faded banners promising 2 months free and no deposit. Adding to the pain, job losses have cut deep. Agriculture, one of Bakersfield's economic pillars, has suffered from drought, automation, and global price shocks. The city's other key industries, logistics and oil, have also weakened, prompting many renters to pack up and leave entirely. The ripple effects are impossible to ignore. Shopping centers are quiet, property managers are slashing rates, and neighborhoods once full of families now display for rent signs on nearly every block. For landlords, it's a sobering reality check. The myth of the safe market has vanished. Oversupply and economic fragility have collided to form a perfect storm. Those who bought investment properties at the height of the market are now underwater, while longtime owners scramble to stay solvent. Yet beneath the hardship lies something more meaningful: rebalance. The excess is clearing out, and for the first time in years, housing in Bakersfield is once again within reach for working-class families. Still, the symbolism runs deep. If even Bakersfield, the city once thought immune, is struggling with vacancies, then California's rental correction isn't on the horizon. It's already here. From Fresno to San Jose, the Golden State's housing story has reached a turning point. After years of skyrocketing prices and landlord dominance, the balance of power is shifting. Tenants have leverage again, vacancies are rising, incentives are back, and landlords are learning a hard truth: endless demand was never guaranteed. This correction isn't just economic, it's cultural. It's reshaping who can live in California, where people move, and how its cities will rebuild. The Golden State isn't losing its shine, it's rediscovering what balance feels like. Thank you for watching Discover the Cities. If this story opened your eyes, be sure to subscribe, like, and share. Every day we bring you the real stories behind America's housing shifts, migration trends, and economic transformations. Because to understand the future, you have to follow where the rent is falling fastest.